What if your exchange rate, instead of being overvalued, is undervalued? Okay, so let's look at how that works. All right, so here's the demand for your currency. So let's go again with Canadian dollars. So here's the demand for Canadian dollars, and here's the supply of Canadian dollars. So this is the quantity of Canadian dollars out in the world, and this is the value of the Canadian dollar. And let's suppose that the market says that the current exchange rate is 1 Canadian dollar equals 1 US dollar. Okay, so Canadian economy is strong, the Canadian dollar is strong. All right, well, what if that's not where we want to peg the exchange rate? What if we want to peg the exchange rate here? So we want the peg to be 1 Canadian dollar equals 90 cents US. Because if our currency is too strong, then Americans won't buy our goods and services. So we want to be just below par. So in this case, what we see is that where we are, so we are here with the peg, and the market says this is where we should be. So the problem is that where we should be is higher than where we actually are. So if where we are is lower than we should be, then we have an undervalued currency. Okay. So we have it set lower than the market says it should be. Well, the challenge with this is that quantity demanded, the amount of Canadian dollars that foreigners want, is more than quantity supplied, more than the amount of Canadian dollars we're putting out into the world market. So there is a shortage of Canadian dollars. And this can create a challenge if we're trying to maintain the peg at 1 Canadian dollar equals 90 cents US. Now, before we look at how you maintain that peg, let's just take a moment and look at undervalued currency. So let's go back to our Big Mac index. And if we were comparing to the US dollar, there are a lot of currencies that are undervalued. Okay, we talked earlier about how China intentionally pegs their exchange rate to be lower than it should be, so it's undervalued. We can see other currencies that don't have a pegged exchange rate, like Canada. We currently have a managed float, and we are currently undervalued. So you can see a lot of currencies are undervalued compared to where the Big Mac index says they should be. All right, let's go back. If we were trying to maintain this peg at 1 Canadian dollar equals 90 cents US, then we need to figure out a way to get what the market says it should be to be where the peg is. Otherwise, whenever there's a shortage, market forces are pushing the price or the value up. And we want to maintain it at 1 Canadian dollar equals 90 cents US. So what could we do about it? Well, there's really only two options when you have an undervalued currency. Option number one is to revalue the currency. So we can say, okay, that peg is too low. Let's now reset the peg at what the market says it should be. So instead of having it pegged at 1 Canadian dollar equals 90 cents US, we're going to set the peg at 1 Canadian dollar equals 1 US. Well, the problem is we don't really want to do that because we had a reason for setting the peg at 1 Canadian dollar equals 90 cents US. We wanted it to be advantageous to our trade to encourage Americans to buy our goods. So it's unlikely we want to just revalue the currency and raise the peg. Plus, the whole point of having a pegged exchange rate is to remove that variability, and if you're constantly changing the peg, what's the point? So likely we're going with option two. And option two is we're going to have to use monetary policy to maintain the peg. All right, so let's look at how that works. Well, monetary policy consists of two things: money supply and interest rates. So if we want to maintain this peg, here's demand, here's supply, here's our peg. We need to get that point where the market says it should be back onto the peg. So we're going to need to take the money supply and increase it. If we increase the money supply, then aggregate demand, so more cash in people's pockets, then aggregate demand will go up. And when aggregate demand goes up, so here's aggregate demand, here's aggregate supply, here's real GDP. If aggregate demand increases, then real GDP does what? It goes up, okay? And when real GDP goes up, then income goes up, right? Households have more money. The economy is growing. We're demanding more goods. And when income increases, we start buying more foreign goods. We start going on more foreign trips. And if imports are increasing, then that means demand for foreign currency, like the US dollar, is going to go up. We need more foreign currency to buy foreign goods. Well, if the demand for the US dollar goes up, then that means we have to take our Canadian dollars and trade them for US dollars, so the supply for Canadian dollars out in the rest of the world goes up. And that gets us back to the peg. Okay. The other part we can look at is the other part of monetary policy, which is interest rates. And when the money supply increases, what happens to interest rates? Interest rates go down. Well, when interest rates go down, investment spending goes up. That makes aggregate demand go up, which makes real GDP go up, which means more income, which means more imports, which means, of course, we're going to buy more foreign goods, so demand for US dollars goes up, and the supply of Canadian dollars increases. The other way you can look at the impact, just add one more graph or blank page here. The other thing we can look at when you change interest rates is the change interest rates have on foreign investment. So if interest rates go down, then Americans want to invest more or less in Canada. So when you're trying to decide, whose stocks and bonds to buy, you choose the stocks, bonds, or mutual funds that give you the higher rate of return. So if interest rates are higher, okay, then that means foreigners want to invest in your country. So if interest rates are higher in Canada than they are in the US, then American investors will start buying stocks and bonds and mutual funds of Canadian companies. Okay? Well, if foreigners want to invest in your country, then what do they need to do that? They need Canadian dollars. So an increase in an interest rate will cause the demand for Canadian dollars to go up. When interest rates go down, foreigners want to invest elsewhere. They don't want to invest in your country. So what happens to the demand for Canadian dollars? It goes down. So when interest rates go down, that's going to help if we have, here's demand, here's supply of Canadian dollars. All right, here's the market value of the Canadian dollar. So we had in our previous example that the market had that 1 Canadian dollar equals 1 US. and we had it pegged at 1 Canadian dollar equals 90 cents US. Well, when interest rates fall, so foreigners don't want to invest in Canada anymore, the demand for Canadian dollars decreases, and that also puts you back on the peg. So when interest rates go up and foreigners want to invest in your country, then demand for Canadian dollars increases. So when would you increase interest rates? Well, if you had a pegged exchange rate, and here's the market, and you pegged it up here so that it's now overvalued, well, in this case, if you increase interest rates, foreigners want to invest in your country, the demand for Canadian dollars will increase, and that will maintain your peg. So we can see how monetary policy and its impact on both domestic consumers and foreign investors can be used to maintain the pegged exchange rate. But just as with the overvalued, if your currency is undervalued, you're using monetary policy to maintain the peg, and that may not be advantageous for your economy. So you may not want to be increasing the money supply and lowering the interest rates for your economy. But if you want to maintain a pegged exchange rate and you have an undervalued currency, then you have to do it to maintain the peg. And the challenge with this is that means that monetary policy can no longer be used to stimulate or slow down the economy. So monetary policy can no longer be used to close recessionary and expansionary gaps because now you're devoting your monetary policy to maintain your exchange rate. Well, when we look at countries like China, who have an undervalued currency, so they're living in this scenario here where their currency is undervalued, they're having to devote their monetary policy specifically to maintain the peg. And the problem is this is not always sustainable. That means they're continuing to have to increase the money supply and lower interest rates to maintain their cheaper Chinese yuan so that we'll buy more of their goods. But that also means that you're printing more money when your economy may already be growing a lot. And if your economy is already growing and you're now printing even more money, this can create a problem for your economy. It grows too fast, you get hyperinflation, and so on.